Good morning, good afternoon. Hello, everyone. My name is Rick Calvoda, co-head of Global Advisory at Altus Group, and welcome to our second quarter market performance call. We have a great turnout this time, expecting almost 300 people on this call. So I think the returns this quarter probably helps with some of that interest this quarter. So look forward to talking with you today. Again, this call is our second quarterly call where we discuss not only property level return performance for the quarter, but also insights into underlying valuation trends that drive those total returns. As a reminder, the performance information discussed today that we'll be presenting is for the NCREIF ODCE index, and it covers all 27 funds in that index. The valuation data we present is reflective of the 25 ODCE funds we work with, but it's also based on insights on the more than 10,000 valuations that we oversee each quarter on assets totaling in excess of $800 billion of gross asset value. By analyzing the underlying pricing and cash flow assumption changes, we're able to not only help you understand the value changes in the prior quarter and how that impacted the returns, but it also provide real-time insights into the current valuation process that we're all going through right now. You will also see this quarter some reference to some analysis completed by StratoDem Analytics, a predictive analytics company that joined Altus Group in May of this year. StratoDem's machine learning capabilities not only lend well to understanding the valuation data collected in our quarterly valuation processes, but is also reflective of where the future of real estate industry analytics is going. If you'd like to learn more about StratoDem and the information that they can provide and the analytics they can provide, you can reach out to any one of your Altus individuals or ourselves that you work with, your Altus rep, and we're happy to get you connected with our business development team for more information on that. Returning again this quarter to present these insights are Phil Tiley, head of our data analytics team with over 30 years of performance measurement experience, and Robbie Tanjung, who heads up our US Global Advisory Group with over 23 years of valuation experience. Please note that we'll have about 10, maybe 15 minutes at the end to answer any questions you may have, so be sure to submit your questions through the chat feature of this webinar. Also, as I mentioned earlier, this is a quarterly call, so you can mark your calendars now for November 4th, which will be our next performance call for the third quarter of returns coming up in about 3 months. So again, thank you for joining. I'll now exit the stage and pass the presentation to you, Phil.
Thanks very much, Rick. Hopefully, can you hear me okay, Rick?
Yep, all good.
Good, great stuff. Okay, thanks very much and for the intro and following on from Rick, thank everyone for joining the call today. And then more broadly within Altus, a big thank you to everybody. It's a team effort to pull all this information together. So the performance analytics team, Mike Amthor working alongside me, but the wider advisory business bringing that valuation data set together to give us even more insight into these performance numbers. And now, as Rick mentioned, the StratoDem piece as well, which we'll touch on. So a lot to cover. So let's get straight into the material. So headline returns are up top. So just to preface, what we're focusing is on the ODCE index, the pure real estate part of it. There's no leverage, no cash, and we're looking at how actual real estate returns played out, net of fees, during the pandemic, and more specifically where we are now. So let's go right to the top, where for the quarter, returns were rising to a record level. That's a record within the ODCE history of a quarterly return of 3.5%. Return. It is superseded in terms of the level of return by the NPI if you go back to Q4 2010 when the market was recovering from the GFC, but a far quicker recovery we're seeing around the pandemic, and that 3.5% return almost making the downside of the pandemic from a return standpoint feel like an increasingly distant memory. But that's at overall level, and there are lots of variants within that statement, which we plan, Robbie and myself, to unravel over the course of the next 45 to 50 minutes with yourselves. So having turned negative back in Q2 2020, returns have been steadily easing back up, and then you have this quantum leap in Q2. Returns, you can see from the insert in every sector, moving in the right direction, and with returns now firmly positively entrenched across each of the major food groups if you go down that Q2 column. That said, it remains a kind of time of huge disparity, and that's, I think, a theme that comes through these numbers, and that's evident first and foremost at a sector level. Industrials, very much in a league of their own, and we say this quarter after quarter, out in front with a staggering near 8% rate of return. That's easily the highest return on record set by an individual sector if we backtrack through the Odyssey time period. Closest rival to that is the other grouping down the bottom there, and near 5% rate of return. So very much in growth mode there. Just to qualify, that's just a little over 4% of the overall Odyssey data set. The majority share of that is self-storage, about 65% of that, 20% senior living, healthcare. You've also got some hotels, just a slither within that, and also emergence of things like data centers as well. But as a collective, as I say, all very much growth assets, even hotels that are starting to recover some of their values in the last quarter. Apartments are next up really across the main sectors, 3.4% rate of return. That's twice the order of magnitude of where they were in the opening 3 months this year. And clearly, having got the better of offices, and we talked about this last quarter, changing the guard between the offices to the multifamily. So spoke to that last quarter really, but offices are a relatively tepid uptick from 0.8 to 1.3. But the key takeaway there for Q2 is that appreciation is turning positive. Within that number has turned positive. Retail still propping up the order at a 1% rate of return, but you get a sense that things are starting to turn around there. Values have really stabilized over the last couple of quarters, so delivering almost on a full income return for the 3 months. For the year, returns average out at a 7.9%, and that's quite a step up from the figure we were talking to yourselves around in Q1, which was annual return of 3%. So we're taking on board that upside of that kind of big step up in Q2, but we're also dropping away the Q2020 offset from that overall total. And still, I mean, significant diverging trends you can see there on an annual basis, north of 20 for industrials. Retails on an annual basis still negative returns. Offices pretty muted, low single digits.
Hey Phil, with the large return from industrial, what is its contribution to the total return? Are they more than 50% this quarter?
Pretty much spot on that actually. So if you strip industrials out of the mix for the last quarter, the return settles down at 1.7%. So yeah, they are making the largest share, contributing effectively half of that return coming from what is less than, I guess, 25% of the value of the overall Odyssey. But I think even if you took them out of the mix, you're 1.7%, and that's not far removed from where the market was, and we were pretty impressed when we were talking last quarter about 1.8% rate of return. So yes, it feels like industrials are making this huge uptick to the overall performance number. And it feels one-sided, but the overall improving trend I think that we're seeing is generally more of a collective effort associated with stability at the lower end of the market, and in the middle ground, things like apartments are kind of stepping up their levels of appreciation. But worth pointing out there, yeah, Robbie, that they do make up half of that overall return for the quarter. And actually building on that point and the lead aspect from the industrials, this chart shows that kind of playing out over the course of time there. That green line at the top there are the industrials. This is rolling 12-month returns. I think we showed this last quarter. And it really does show the divide that's opened up across the mainstream sectors. I think we said last quarter, you go back to kind of 13, 14, there's not a great deal to separate the different sectors. Real estate on an annual basis delivering somewhere between a 9 to an 11% rate of return. Apartments are the lower end of that order, but as returns started to ease off, and that all property line is the dashed line, what really happened is from that point onwards, industrials have remained pretty much the same, in a league of their own, delivering 10 to 15% rates of return, and that rose to north of 20% in the annual return to Q2. Around 2018, you also then get the darker shade bar there, blue bar there, with the other properties moving ahead of the rest of the pack. Yeah, a little bit of a pause around the onset of the pandemic there, but also on a similar upwards trajectory as being charted out there by the industrial sector. And then you're really left with the competition down the lower end of the order to emerge as the best of the rest. So if we just kind of strip those out onto this chart here, and again, to your point, I guess, Robbie, they're all, for the annual at the end of Q2, trending below that all property average. Apartments are starting to distance themselves, that red line there, from the rest. That's a 6.3% rate of return for the year, so 3% appreciation within that number. But then down at the bottom, you have retails. They've gone through that torrid period of correction, but here the decline is easing off and significantly. And now they're very much gaining ground on offices, which have really only registered a minimal uptick in recent quarters. And this is annual. Actually, show this on a quarter-on-quarter basis. You can see there on that arrow there, that's the offices and the retails pretty much neck and neck, as apartments up there now maybe with their sights set on the front runners. Yes, everything kind of takes a knock. You can see that during the kind of midpoint of the onset of the pandemic, midway through last year. But I think the real differential here is how quickly sectors have recovered, and offices, the purple line there, are certainly trailing in that regard. So maybe back to you, Robbie. What's your immediate thoughts on those top level return variances, especially maybe in relation to what's going on at the bottom end of the order? Maybe your thoughts there.
Yeah, I think the two sectors, there's still the uncertainty that continues to linger, right? So just the office and then the retail sector. I think if you look at the retail, that the recovery is definitely underway. So they appear to have a button, right? So with the rebounding of foot traffic, especially in the strip center and even mall, they're not back to pre-COVID level for the mall, but at least the foot traffic is back and the sales there. But it's still continued uncertainty, right? So what is the retail going to look like after all this situation? And then with the Delta variants, what is the government regulation going to look like as well? So there definitely continue uncertainty on the retail front. Office continues to improve, but more cautiously, right? So earlier in the quarter, we definitely have a lot more news with the reopening, right? A lot of companies saying they're reopening, but as we kind of go through the quarter and the end of the quarter, there's a lot more news about Delta variances. Companies are pushing back reopening. Some of them have even pushed back until 2022. So I think that's the two sectors that's lagging behind, is the two sectors that still have the uncertainty about this kind of the overall situation with the Delta variants.
Sure. And we can unpack that in a bit more detail. Actually, let's get into that detail. So next slide returns to the all property results. So let's start to peel back those layers. First here, income and appreciation components. So focusing on the right-hand side to see what's played out through the pandemic, where we are now. Hard to pick out, but those green bars, that's the income return. I think we mentioned this last quarter, they did dip a fraction through 2020 as reductions in rents had that kind of immediate near-term impact on actual returns. That's kind of some of those rental reductions have started to unwind, and that income return has edged back up by about 10 basis points. But the real story is on those red bars around those appreciation numbers. And I mean, as the pandemic took hold, those values went into reverse, and after what's sort of been an extended period of growth, focal point of the decline very much Q2. We've now had 3 quarters of positive appreciation. Last quarter, we were commenting that appreciation was back around about those 2017 levels. Q2 now setting record levels of growth, and that actual 2.4% appreciation in the last quarter alone pretty much reverses out those declines that we saw through 2020. Obviously, there's lots of sector-specific variances within that, and let's get into that detail. So what we're able to do at Altus is then unpack that appreciation and return. So here usual form, we transpose that red bar into the red line, and then we bifurcate really the red line into what's termed the yield versus the cash flow drivers on that appreciation level. The yield effect here in the yellow is the impact of what might be termed the kind of pure pricing levels on value, so the impact of change in discount rates and exit caps. And for cash flows, we're identifying the impact on value of the change in those forward projected cash flow levels. CapEx is the third layer, the grey bar, so you don't kind of bank all of that kind of appreciation return, and that 2.4% is taking into account the net of the amount of money that's spent into properties, so reducing that kind of valuation upside by 30 basis points during that measurement period. So having gone through that period of decline, values are now very much back into what I would term firmly into kind of dual positive territory. And that's the real difference in the appreciation we're seeing in Q2 from Q1. So it's not just in the order of magnitude, yes, it's also in the makeup, in that it has more of a kind of that blue bar, more of a cash flow underpinning there in that blue bar than we saw in the opening 3 months of this year. That's in addition to that run of positive investor sentiment as indicated by the yellow bars. And it's that duality that's kind of pushing appreciation up to record levels. But these are all property averages. The next slide shows really the need to go down further into the individual sectors, which have a very different set of circumstances. So the same kind of interplay analysed here across the 4 major food groups. So here you want to be focusing on the right-hand side of each of these charts. First off, on the red lines, it shows that the growth is still very much confined, and as Robbie, you were applying to the apartments and the industrial sectors. If you start out with the apartments and just see what's playing out here, here the main talking point is for the quarter is how those cash flow reductions, those blue bars that went below the line, the hit values at the focal point of the pandemic, midpoint last year, but then continued to contract even to the opening 3 months of this year, have now started to unwind. And prior to that, the protection has been afforded by the positive pricing adjustments. Values have been kept in check by the scaling back of those forward projected cash flows. But we're now starting to see those cash flow positions reverse. So what we have, there's that dual positive effect for apartments now pushing up values. And that dual positive is something that's kind of been ever present there within the, present over the last few quarters within the industrial sector. And unlike any other sector, cash flows really haven't come under any downward pressure. Quite the reverse, after what is just a momentary pause at the onset of the pandemic, kind of Q2 of last year, they've been strengthening and stepping up quarter over quarter. Just down to the offices, a few kind of comments around here. On the downside, no real movement on pricing throughout the pandemic. So you don't really see any of those yellow bars coming through here. Level of cash flow contraction, those blue bars, has eased, not turning positive or turning slightly positive, but not to the same order of magnitude that the multifamily sector is witnessing above that. And so I guess while we're seeing a bit of stability in the office markets there, that does mask a whole variation, both at regional and localized urban versus suburban, and we can turn into that in a second. Retails have almost been the polar opposite of industrials. Those headwinds, though, have definitely begun to ease and really almost at a standstill in Q2 from both a yield and a cash flow perspective. But again, that's a pretty sweeping statement. Generalization, we need to look at variations of the subtype. But Robbie, to you, any surprises there for you or thoughts on maybe what's going on behind the scenes? I know we'll dig into this a bit further, but your immediate thoughts and comments around that?
Yeah, it's very similar to last quarter, right? So it's lead by industrial and apartment. The only difference is everything else turning positive this quarter, right? So if you look at apartment side, similar to what we discussed last quarter, we're talking about investor demand in Sun Belt just because the job growth, right? So job growth typically will lead to rent growth, right? And I guess that's turning positive this quarter, right? So with the cash flow positive in there. So definitely a lot of demand continuously, right? So, and we'll unpack that later on as well with the Sun Belt and other region. So it is about job growth story as well, and that continue on the apartment front, right? So industrial, it's all about limited supply, right? So the story about tight vacancy market in the coastal market, and with tight vacancy, and then the shortage of labor for construction, the elevated construction costs that slow down the new supply as well, so that exacerbate the tight availability in the coastal market. So that's driving the significant cash flow adjustment. And if you look at investor demand, it's almost every week we turn on our news, right? So there's always a transaction on industrial, large transaction on industrial, right? So the strong investor demand still continue on industrial. So that's why you get the double positive there. And office seem to have hitting some resistance level, right? So again, cautiously, right? The way it is right now with reopening, right? So, but at least in there, that's slightly turning positive. Transaction are generally limited to the core asset right now, right? So if you look at this a transaction on the market that's going on, for example, the 1K Fulton that sold for 355 million at kind of low 4 cap rate going in, and you get the exchange building over $1 billion at kind of a high 4. So you can still see some trophy big ticket item transaction in the office, right? But it's still limited to what I call it the core asset. The value add asset is on the market right now, so it's increasing in the market, but there's no full clarity on it yet. So people can agree. There's something we're going to continue to monitor over the next couple of quarters or so. And on a retail front, again, it's all foot traffic to come back. We will discuss that later on as well. But again, on transaction front, it's typically limited to grocery anchor, right? So just because the financing are still limited for like a mall or lifestyle center yet. So.
Okay, yeah, no, thanks for that. And I guess for me, it's whatever sector you look at, and actually the next slide maybe does this justice and just focuses on that on the last quarter. So you know, it's really a story of green shoots are really starting to emerge, and across the board, but to varying degrees. So here for the last quarter, we're ranking the major food groups there in terms of their appreciation, decoupling again into the yield and the cash flow effects. But it feels like almost a watershed moment, because now everything on those yields effects and cash flow effects at the right hand side of the line, albeit minimal, I guess, in the case of retails and offices. But if you look at the rank order in terms of appreciation, the effects of yield and cash flow are both playing their part in determining that hierarchy. But for me, the real plus point is on those blue bars, the fact that those cash flows fundamentals are strengthening again. Bearing in mind, for apartments, for retails and offices, they were all negative in the opening 3 months of this year. So what we then do, we break out that cash flow piece and look at a series of 6 key metrics. We've done this in prior quarters, and we get in this level of detail when we analyze each of the individual portfolios on a one-to-one basis. There's no perfect science here. The color coding does give you a sense of what's having a positive impact or negative impact on those forward projected cash flows, and it's predominantly greens across the board. Rent growth and market rents, the change in those upfront based market rents up across the board. I was a little bit taken aback when we first looked at this in terms of that market rent growth, upfront market rent growth associated with retails, but it's not having such a significant impact on the ultimate value, given, I guess, the levels of over renting that are prevalent within the retail sector. So not having a direct impact on value when you compare that, say, with the even stronger market rent growth on the industrials, but they're setting record highs in that sector with those new rent growth levels, and therefore having an immediate impact on value, so to speak. Offices and retails, red bars there on occupancy, so still being pegged back with further vacancies. Interesting maybe to watch that one for offices as firms possibly start to downsize, and I'm certain they will in some sectors their space requirements. The other metric to kind of keep a watch on, and that I kind of pulled in this quarter, is this capital cost ratio on the right hand side. This is the change in the average annual budgeted capital spend as a percent of value, and we really see that tilting to the red zone, especially in the case of the offices. It's where the investors are realizing they need to invest more into their assets to ensure they remain competitive in the wider market space, and that in part is keeping some of that valuation change in check. We'll return to that, especially when we look at the offices. A quick word on those rent growth rates. They're going up. They're 10-year averages. So let's break that down into the 1, 2, and 3 years. So on the 1 year, this is the change over Q1 to Q2, the levels of changing that year one rent growth adjustment. That's trending back up, having been scaled back significantly during the pandemic. They're still sub pre-pandemic levels of rent growth. I'll come to that in a second. But the 2 and 3 are actually pushing north of where we were at the start of the pandemic. Actually, the next slide does that justice. So that's changed over the quarter. This is then going back over looking at things over the last 2 years, and you can see, go back over the last 2 years, then that rent growth rate for year one is still south of the mark of where we were pre-pandemic. So evidence that the effects of COVID are still suppressing growth rates here in the near term. The 2 and 3 year rates, though, are ahead of where they were back in June 2019. So kind of predicting stronger growth levels going forward. The other point to pick up, and this is really the effects through the whole of the pandemic, is this metric here, that year one operating expense ratio, which we've talked to before. So this metric measures the ratio of the year one projected out operating expense as a percent of the year one anticipated gross rent. So an increase there is one of two things: either expenses are being projected to have risen through the pandemic, or rents in the near term of that year one period have been factored down as a result of concessions and pushing out leasing assumptions. And when you're looking over a 2-year period, that's definitely in the red zone. That's what we've seen through the pandemic, and that's what put the downward pressure on those cash flow levels, reducing values. And this is almost kind of not telling the full story, because this actually goes back to June 2019. So if we went to just stopped at kind of December 2019 to capture just the pure pandemic period, you'd see more offset in that regard. But this is the kind of level of detail we'll take forward when we talk to our clients on a one-to-one basis, as well as getting into the variance that we're seeing across different kind of parts of the sectors. And so here, looking at the geographical variances. I won't spend too long because we're going to deep dive into each of the individual sectors here. But just to explain again, these are the Q2 returns. So that's our 3.5% rate of return, how it varies across the sectors, and then within the sectors, how the returns play out across the major metropolitan markets, ordered from west to east, separating out the top 15. What's not in the top 15 is in that other group of what might be termed the less non-primary market, so to speak. So anything in green is returning above its sector average, anything in red is below its sector average. Put the Q1 numbers in there for comparison. Q1 minus Q2 basically just shows that, well, pretty much the majority of it is moving upwards. So market returns strengthening pretty much across the board. As I say, I'll go through this sector by sector, but just a kind of quick level observation on the greens, West Coast. There's definitely a kind of West Coast bias to some of those stronger levels or more robust rates of return. The pressure points go down: Houston, Chicago, DC, New York, but there's variations even within those metropolitan markets. And we've talked before about, New York industrials being one of the stronger spots. So you do have to go into the individual sectors. So let's go into that sector by sector, and then I'll we get your thoughts around these as well, Robbie. So up top, just to explain, because there's almost too much detail, I'd say there is on this chart, but so apologies for that. You have that Q2 2021 rate of return down the bottom, the most recent period, and then the prevailing 4 quarters color coded in terms of whether those metropolitan markets are delivering stronger or weaker returns than their respective sector averages. And it's, Robbie mentioned it, it's the Sun Belts that at the onset of the pandemic, Q2 2020, kind of proved the more resilient and are very much coming out of it on the front foot. Phoenix, 7.8% return. Miami, 6.3%. That's strong in the context of apartments, a bit strong in the context of the overall Odyssey as well. Whereas the gateway markets have borne the brunt of the decline and are still very much in the red zone. San Francisco, Chicago, New York, for example. And then we've decoupled those contrasting fortunes, taking a couple from each of those groupings, breaking down their appreciation returns, taking that back, and looking at interplay between yields and cash flows. So on those Sun Belts, selecting out Atlanta and Miami, And they've really only been subject there to 1 quarter really of negative appreciation right at that kind of onset point of the pandemic. Since then, very much on an upwards trajectory, but until Q2, that's really been courtesy of those yellow bars, those positive pricing adjustments. But what we've seen in the last quarter is then a recovery in some of those cash flow levels, and that's a real point to note, I think, that we're seeing coming through in the latest quarter. Contrast that with the fortunes of a couple of those gateway markets, Chicago, New York, who have A, experienced more an extended period of write-down, B, on the upside, very little yellow, very little positive pricing adjustment, and C, a minimal reversal of those cash flow adjustments in the latest quarter. And then if you look at things on the full 12-month, look at appreciation there across all those CBSA markets, and then look at that appreciation in terms of the yield and the cash flow. The contrasting fortunes here and the appreciation are partly being played out, yes, on the pricing side of things over the 12 months, but more on the cash flow variance side of the equation. And that in turn is then being played out when you look at changes in contract rents and market rents, differentiating the top from the bottom end of the order. Yes, this isn't conclusive. There's growth rates to consider. There's near-term changes in concessions to consider, but the fundamentals are definitely going to differentiate the top from the bottom end of the order in that respect. So maybe to you, Robbie, thoughts there on really what you're hearing on the ground, I think would be helpful.
Yeah, the overall, the Sun Belt continued to shine, right? So in here, like out of the 4 markets we highlighted, the 2 of them was Atlanta and Miami, right? So Atlanta and Miami, good job growth and positive net migration market, right? So with Atlanta recently as well, we see a lot of the tech company increasing the workforce, like Facebook, Google, Microsoft, that expanded that market, right? So investor demand as well, like Atlanta is the 2nd most active market in terms of transaction volume as well. So Miami, as we discussed earlier, previously as well, is a positive net migration, right? The other thing as well in Miami, the migration also with the higher income, the out migration with the lower income. It is the 2nd highest concentration of banking and financial in the U.S., right, outside New York, right? So, and both of them kind of good job growth, which also good positive net migration that's kind of translate to strong rent growth, which is what's showing this quarter as well with the positive kind of yield effect. The bottom side is the gateway market, right? The Chicago, New York, that's started to improve. So you see the positive blue, right? So as office start to reopen, but it's still lagging the Sun Belt market.
Yeah. Actually, that what you say there kind of links in nicely with this, doesn't it, Robbie? This is the information hot off the press from Stratodem. So that exactly chimes pretty much with what you're saying.
Yeah, and then and then with Stratodem acquisition, right? So we can take all this data and then we can try to quantify why the market and asset performance across the property types. So in here we run it against the apartment, right? So the data set we can run it against is like an alternative data set using mobile phone data, migration, traffic volume, and employment, right? So in here it kind of showed that the strongest predictor of the net return basically on the Q2 is the mobile traffic data, and net migration is kind of a good predictor of it, right? So, and then the other thing as well, as we talk about job growth, so sustained employment growth is basically, and also with lower supply growth as well, will kind of show that it is have a positive slope as well. So, in here, trying to pinpoint one specific market in here, like we can see Phoenix is the top in all 3 markets, and in the previous slide as well, it showed Phoenix actually have been outperforming the last 4 or 5 quarters, right? So, and they have done a good job basically in recovering commuter volume, continue to attract migration and employment, right? So that's why they sustain that positive return compared to other market. On the other hand, the bottom side, we saw Chicago, right? San Francisco, basically losing population, slow employment growth, that basically driving lower apartment return. So now we can use this data to run it on a portfolio basis and an individual basis. That relations still continue, right? So still kind of right? Relations still hold. Basically, we run it on individual asset or basically on portfolio as well.
Yeah, and I think that's the point for me, though. I've just started to work, Mike Canthor and myself, working with the folks who come across from Stratodem, and it really kind of it nests so well with what we're doing in terms of when we talk to the clients as well, because when we talk to the clients about allocation plays versus property specifics, this is a great illustration of the allocation piece, giving us those broader factors that are attributes that are kind of differentiate kind of performance levels across different geographies. But then the next stage down from this that Robbie is hinting at is then looking at performance of properties within those respective markets, and then the attribution that they're able to then drill into in terms of what are the property specific attributes that differentiate one set of properties in San Francisco versus another. And they've done a ton of work around this. They work at breakneck speed, which is brilliant. We're, I think, and as Rick mentioned at the start, already out there talking to a few clients. As we talk to our ODCE and all the wider set of our performance clients over the course of the next few weeks, we'll definitely be getting people's thoughts back on that. But it's definitely, I can see how this becomes a real firm feature in terms of adding real value to what we're able to provide. Back to the performance and the valuation numbers for the offices. What we're really seeing, and this is where we're seeing that kind of that green to the left-hand side, that West Coast bias playing out. Markets that have proved more resilient and coming out with a slightly more robust rates of return. Alongside that, we've commented before about Boston fast becoming a destination for life science and playing positive in the overall attraction of that marketplace. Contrast that with markets that have been under pressure, the Chicagos, the Houstons, Miamis, DCs, and New York. So down below again, focusing on the upside for Seattle and Boston versus kind of the more downside of DC and Chicago, and looking at that interplay of yield versus cash flow. So on the Chicago and Boston at the top, yes, yeah, if you look at those blue bars below the line, yes, a couple of quarters of reduced cash flow, and that's, I guess, as office markets countrywide experience that, and you see there for Boston as well, that mass exodus from offices to remote-based working. So concessions were granted, growth rates were cut back, but those cash flow reductions in those markets were pretty short-lived, and they've been kind of improving in each of the last 3 quarters. You contrast that with the fortunes down below of DC and Chicago, where values have come under more intense but also more prolonged with pressure, with those reductions of cash flows being drawn out. Also on the yellow, no, we didn't say we're seeing it at top level, but some additional risk being priced into those markets. And on the cash flow side, those contractions, although they've eased a little, they've not really reversed the other way that we're seeing in the likes of Seattle and Boston. And if you take the full spectrum of those office CBSA markets and look at that yield and cash flow relationship in terms of how it plays into that hierarchy of appreciation, you have opposing influences on both sets of those metrics. So when we looked at the offices overall, it all looks pretty static, but you've got real bifurcation here in terms of opposing influences, both positive, negative, pricing adjustments, top and the bottom end of the order, strengthening cash flows up top, cash flows have been contracting, and this is through the last 12 months. So this is dropping that Q2 2020 period as well, and those kind of cash flow fundamentals kind of being reflected what's happening in those market rents kind of declining for New York and DC versus improvements at the top there that we're seeing for likes of Seattle and Boston, which are kind of singled out on that price slide. And also here, that capital cost ratio that I mentioned before, this comes into play here really on the offices. Lower down the order, those properties are being subjected or thinking through the need for, I guess, more defensive capital outlay or kind of budget expenditure for a more strategic repositioning of those assets, and that's taking its toll on those near-term values. So, Robbie, any specific thoughts there in the positioning of any of those individual markets?
Yeah, do I look at it? It's about the industry strength, right? So if you look at the Seattle, it's more about technology, cloud computing. They have a strong office employment growth actually in Seattle as well, right? So that's kind of driving the Seattle market with tech and cloud computing. Boston have been connected, the life science, right? The booming life science industry in that sector. 7 of the 10 largest biotech have a presence in Boston, so it's going to continue to grow that Boston. And then San Diego is kind of a combination of both, actually. They get the life science component with biotech, and they get the technology aspect as well. Versus the bottom one is a gateway market, right? So Chicago, the New York, the DC, they continue to be the lagger, right? So a lot of this market also have a high business cost, high regulatory cost with the transfer tax, and then the property tax question as well in that market. So.
Sure, thanks. Okay, let's go into the industrials, and then we'll change tack a little bit. So same approach for the industrials. If you look back to Q1 2020, go back to where we are now in Q2 2021. Right at the start, New York, New Jersey, in those earlier quarters have very much been leading the charge. They've now been surpassed by some of those West Coast markets. Real standout, 12% return there for Inland Empire. San Diego's a lot smaller sample, but staggering their return in Inland Empire. LA also kind of rising up the rankings. Lower down the order, you have that kind of column of inland markets running down that middle of the table: Dallas, Houston, Chicago, Denver, and actually I've singled out Chicago down here, and this is all the same scaling here, just to give you a sense of the differences we're seeing. Yes, yields and cash flows are still positive and having an accretive impact on value in Chicago, and you've seen that in the recent quarters, but eclipsed really from what we're seeing in the likes of New York, and more recently that staggering uptick in Inland Empire and LA. And our valuation data pinpoints really what's spearheading that strengthening of those cash flows at the top end of the order. And it's all about those kind of rental levels, record market rent levels being recorded. This is for the full, again, just to recap, for the full 12 months. And so, that's 9 to 17% levels of market rent growth. Contrast that with Miami, Denver, Chicago, low single digits at the bottom end of the order. So, Robbie, any input there in terms of what really sets those markets apart at the top end of the order?
Yeah, it's a coastal versus non-coastal market, right? The coastals we talk about, very tight vacancy. Inland Empire, LA, less than 2%. New York, New Jersey is about 3.5%. And this market also has shrinking land availabilities, right? So with continuous demand, tenant demand, strong kind of rent growth in all this market. Versus the bottom one, when we highlighted Chicago, we didn't put Chicago in every single one just because I'm in Chicago right now. It just happened Chicago tend to be the bottom 3 in almost all category, right? So again, industrial actually the bright spot in Chicago, right? So it is kind of the location, is central location with good transportation connection. You can reach a large portion of the United States within 1-day drive. But it is lagging compared to the other market. Part of it is that the limited supply barrier, right, and also relatively higher vacancy as well. So you can see that the later slide you're going to show Indianapolis being better. Yeah. Indianapolis is just adjacent to Chicago, right? So it just basically is easier and cheaper to build in other markets, so compared to where Chicago is.
Well, thank you there. So let's change tack a little bit. So looking beyond those broader geographical spectrum, focusing on the more immediate localities and subtypes. And again, I think this is where Stratum will come into its own, really helping us out as well in terms of some real specific drivers. The blue bars here are the actual returns for the 3 months in Q2. Not to be confused with those numbers down the bottom, which are actually the weightings of those properties account for within the overall data set. The dotted line is that Q2 return for the overall Odyssey. So let's start with retails here. Everything back into positive territory. The larger destination centres, those super regionals, a little bit off the pace of the rest, and actually on an annual basis. Well documented, well versed story. The worst affected are those larger malls. On the apartments, there's definitely the standout there in terms of those garden, more suburban, which have emerged as the front runners. And actually outside of the industrials and I guess storage, they're one of the few property types that have actually outperformed the all property average. So from a portfolio analysis standpoint, it's portfolios with more of a tilt towards those garden type multifamily industrial storage assets that have that structural advantage, especially if they have less exposure to malls and CBD offices. And actually on the office point, you can see here that across each different subcategories of offices, they're all below the all property average. Here we're now breaking out what was previously just suburban and CBD. NCREIF have done the work to break that out into the four-way categorization. So suburban is now suburban business district and urban. So suburban business districts have stronger, certainly more so than the CBDs. This is for the quarter, but for the full year, actually what kind of started to tweak my interest was the fact that it's actually the urban part of that suburban prior bracket, followed by the CBD, SBD, the suburban business districts, more so than the further out suburban, that actually have provided the more robust rates of return within that prior suburban categorization. Yes, it also throws into sharp relief the challenges associated with the more downtown markets. But yeah, that urban ring is definitely kind of emerging and has emerged as the most resilient part. And that surprised you, Robbie? Kind of any thoughts around that one?
Yeah, I think that there's more analysis that need to be done, right? So we just got this data recently. Just for example, the life science building, a lot of them are located in urban side, right? So urban and suburban business districts. So that's kind of skews some of that number. And the other thing as well that we know the CBD are generally the gateway market, and urban, suburban business district are typically the Sun Belt and other markets is doing better, right? So, so it's partially as when we can hear it as well in CBD market, a lot of people migrating out. So there's going to be some satellite offices outside of kind of the CBD. It could be in the urban ring, right? So that's definitely positive on that side. But yes, it's not surprised me, but we need to definitely dig down a little bit more to understand which part of it comes from the life science, which part of it is through CBD, and then the other thing as well, on occupancy, right? Like we know the suburban typically have a lower occupancy compared to the other markets. So, but yeah, with this thing new, we definitely need to unpack it a little bit more.
Yeah. I'm proud of the pandemic. Suburban looked like it was off the pace, so maybe just a kind of quality of asset point here. But yeah, the similar kind of, I think the research committee on NCREIF kind of had a similar kind of narration around those numbers on a couple of conferences back. So hopefully everyone together in person in November to thrash it out. Couple of final slides, just a quick deep dive into the retails. A few words there. Regionals on the bottom right. So green shoots there. Start to see some of that cash flow begin to unwind. Yes, there's been significant amount of concessions, reducing those rent growth rates. There's some of that is coming back, but a long way to go still. Not really seeing that on the super regionals. Outside the malls, I guess the real positive point for me there is value's now holding steady for a couple of quarters. So I think things moving in the right direction. Any words of caution around that, Robbie, as to why things maybe aren't kind of moving ahead at more at a breakneck speed?
Sure. Yeah, I think on the grocery anchor, which is part of the non-mall, right? So the grocery anchor, definitely the foot traffic have come back. And we also see the market rent on the grocery anchor have increased as well, cool. Right? So, and you can still get financing, so there's transaction there. So if, like a couple deal on the market, definitely have a lot of interest, right? So, but the mall and then any larger kind of a power center, lifestyle center, it's really hard to get financing, right? So no one really willing to kind of bet fully yet on that side. So, but generally, the grocery are definitely moving, but the other market is basically dragging the retail down right now. So.
Oh, sure. Thanks. So finally, the other deep dive we provided, and huge apologies, there's way too much going on in this slide, but let me just narrate you through it. The title really says it. That other grouping, when you're getting outside the primary markets into the rest of those CBSAs, they are delivering a stronger return, nearly 10% there versus what's still strong for the year. This is an annual return of 7.6 across the overall ODCE. So kind of unpicking that apart, we kind of started to delve into this last quarter. A lot of it rests in, you can see the chart down here, the returns that they're getting across the overall ODCE within the sectors versus in that other grouping. So yes, apartments and industrials, stronger returns are coming out of these non-primary markets. on the apartment side of things, we're definitely kind of picking out on those red dots. Some of those further gateway markets, sorry, not gateway markets, Sunbelt markets in terms of Charlotte, Tampa, Orlando's in there, Raleigh. So those that we classified even across here, thinking to Austin, I picked out. Also San Antonio, stronger kind of returns coming out of the apartments in those Sunbelt locations. Industrials we picked out last time, the kind of spreading out from New York, New Jersey into that I-95 corridor, Trenton, Baltimore, Philadelphia, stretching out that way, all delivering out those returns now, mid 20% rates of return, near 30% rates of return. And then you've got the weighting story as well, because if you're looking into that other grouping, the grey, that's your industrials and the apartments, they have more of that chunk of that other share than they do within the wider Odyssey. So there's a bit of a weighting story, but some of those non-primaries also delivering some of the stronger returns. Any kind of closing thoughts on that one, Robbie? Also, I didn't mention into the offices there, where I guess you've got Austin there.
Yeah, it is kind of pretty consistent as what we talk about, the Sun Belt, right? So, and then the coastal market for industrial, and then the adjacent kind of to major market, alternative kind of the alternative market, right? So, for example, like Indianapolis, as I kind of alluded earlier. So.
Yeah. Okay, I think we're coming up against the hour, so there's just some closing thoughts and comments there. Yeah, a staggering set of numbers. So very much looking forward to talking to all of the clients, getting their individual thoughts right now. I don't know if they've been firing questions through to the chat box. Value change, we were still talking last quarter net deficit since the onset of the pandemic. We're now net positive, and actually that net positive has pretty much been corrected through that appreciation we saw in Q2 alone. But I think the real turning point is both kind of positive pricing, but also positive cash flow adjustments in all those sectors, as some of those cash flow reductions are unwind. Leads and laggards, kind of the same as we were talking last quarter as well, and coastal industrials, West Coast offices, Sunbelt, multifamily, non-primary markets. Still challenges around those CBDs, those gateway apartment markets, and the malls. They're still a little bit behind the rest of the pack, but retail's not yet kind of really flurrying. But maybe back to our chair, Rick, see if anything's come through on the question side of things. But I'll pause at that point.
Yep. No, thanks, Bill. Thanks, Robbie. Again, excellent job. A few questions here. We'll try and get them before you completely lose sunset or sunlight over there, Phil, on the other side of the pond there. Yeah, phenomenal quarter again for industrial. I mean, when the quarterly return for industrial exceeds the annual return for the other major sectors, you kind of have to sit back and think, wow, and it begs the question, how much more is left? I think I mentioned last quarter the number of ships in the harbor here. I think it's 37 waiting to unload as of Tuesday. So there's still demand there. What do you think going forward for industrial?
I mean, Robbie, you're almost very better placed, but I mean, just having looked at some of the numbers that sit behind this, I mean, individual properties there in the last quarter, we're talking near 8% return for the quarter of the industrials. Inland Empire double digit. Individual properties are up at 20% returns for the quarter. So yeah, maybe you're the better eyes on the ground, Robbie, around that. That's just some numbers to throw around.
Yeah, I think the way I look at it is there's not enough supply, right? So as you indicate, Rick, there's a lot of kind of ship, there's a lot of people want to be industrial space, but with vacancy, kind of look at IE less than 2%, right? So what is the real vacancy if you look at it kind of the state-of-the-art building? It's pretty minimal, right? So, and any rent is just basically, we have not reached the ceiling yet on the market rent kind of on industrial, right? So the rents seem to be every quarter continue to be higher and higher, right? And tenants are paying for it, right? So because the reality of it, the rent part of the expense for the operation is relatively minimal, right? So labor cost still a big chunk of it, transportation still a big chunk of it. So right now tenants are still paying just because it's not enough space, right? So and the construction are not fast enough to fulfill that demand. So.
Okay, good. So more of the same. or more increases anyway, going forward. Maybe flip to office. A question on, so yes, it's not seeing the kind of returns, but just given all of the headwinds that office is facing, I think we saw on one of those slides, just the reduction in occupancy for office. Given the headwinds, with work from home and all of that, and potentially, now with the Delta variant, more lockdowns, how do you explain the value increase in second quarter, or just more recently?
Yeah, I think that part of it, this transaction, right? So if you look at transaction on asset, a long-term lease is already above pre-COVID numbers, right? So that's factual that people selling the asset. There's one part to it. And the second part to it, there's actual leases coming due, the leases that are being signed. Granted, the face rent have been the same. They have a higher kind of concession, right? So as you sign new leases, you reduce that risk as well, right? So you extend the average lease term. If you look at the CBD average lease term, it's more than 6 years, right? So therefore, that adjustment is not as significant, just because you still got cash flow and it's still producing, and basically there's almost like collection have been pretty good as well, right? So there's not a lot of disruption side in the cash flow front, and a lot of Odyssey assets are typically core asset long-term leases as well.
Okay, good. Phil, this one's probably for you. I know we always get this question, is the impact. So what you're looking at is total return, of all properties in the index. Obviously, there's some value add assets in there. There's some development assets, some quote unquote non-stabilized assets. How much of an impact are those properties? How much are they affecting either up or down the overall?
Yeah, so that is a good question. We do get that dialogue going quite a lot with our clients on a one-to-one basis. And it does make an impact. I mean, when we're looking at individual portfolios, those types of properties upon completion, in the current environment are seeing significant write-ups. So in individual portfolios, they can make quite a difference, and sometimes kind of flip things from below to above the line at an individual sector level. Overall, memory serves me right, then the premium on those developments takes the annual return. It's 7.6. You strip them out, it's 7.3. So there's basically a 30 basis point premium coming from those development properties. So the quantum of the market upside that we're seeing is really around the operating assets. 30 basis points upside between 7.3 to 7.6 on the coming from those development properties. But that is evident. The apartments, the industrials, I think also in the office sector. So kind of an indication of the level of demand that's out there for some of that prime high spec product that maybe just isn't available on the open market. So it does play a part, and it is still positive, and we've been seeing that positive trend over the last kind of 3-4 years now.
Okay, I think we're at the end, but maybe I'll throw, if you answer real quickly, Gateway versus Sunbelt. You kind of talked about just the markets and how the Sunbelt, markets have been outperforming the Gateway. Is that a longer term trend? Do you see that as, happening beyond just this reopening, or is that, dare I use the word transitory impact?
Yeah, do I look at it? It is relatively permanent, right? So just because if you look at it in the business side, it's lower cost compared to a lot of gateway market. There's a lot of uncertainty there. We work from home. There's a lot of hybrid model as well. So if you look at it on Stratum side, right? So you can look at it, can be more consistent in terms of employment growth. There's a lot of net migration in there. And there's a lot of job kind of going to that market, right? So we see news all the time that company are moving to the south, right? So, and all that are basically getting job growth, getting more population growth, getting more income growth. On a long-term fundamental, that's actually good for real estate, right? So job growth going to rent growth, right? So, and with job, there's population. As there's population, then you need more housing, right? So, and then as people in there, you're going to spend more, right? It now benefit the retail. So they will look at that ecosystem as people moving in. It's definitely going to stay in a longer period of time.
Well, you mentioned this Stratum, and I was thinking about that on that slide. What would be good to see is those individual markets, maybe color code the Gateway versus the Sun Belt, and I think that'll be even a little bit more evident on there. So we're out of time. So again, Phil, Robbie, excellent job. Thank you very much for this. Everyone, thank you for attending, and we look forward to speaking to you again in 3 months and on November 4th. Thanks, everyone.
Thank you very much. Look forward to speaking to people on a one-to-one basis as well. Thanks for everybody's interest in this.